I'll be doing the session 8 assignment and says investigate market efficiency using the GameStop short squeeze event of 2020 to 2021 as a case study. Verify the accuracy of stated facts, analyze price behavior relative to efficient market hypothesis, predictions, and evaluate whether market anomalies constitute evidence against market efficiency or can be explained within existing frameworks. And the critical first step is to verify the statement. GameStop traded at 0.4 cents in August 2020 against actual historical data. If incorrect, document the accurate figures and determine appropriate communication approach for correcting the professor. Okay, before we get into the collab, we're gonna get into this. So, give me a second. All right. So the provided analysis of GameStop short squeeze identifies several behavioral findings concepts that help explain the event. These concepts just as the market during that period was driven by rationality and emotional trading rather than purely rational decision making based on fundamentals. So here are some behavioral biases and impacts according to the event that happened. And I'm just gonna read off all of them. So the bias was about herding and basically was when traders copy each other's actions, primarily coordinated on social media platforms like Reddit. And what that led to was massive retail buying, and it created initial price spike and momentum. So overconfidence was one, and it was when retail traders believed they could beat Wall Street by collectively driving up the price. And this caused traders to ignore fundamental valuation signals, and it pushed the price far beyond what was warranted. And there was FOMO, which was late buyers that felt pressure to enter the trade to participate in the perceived massive gains, and this drove bubble behavior, with buyers entering at peak prices, and it contributed to the rapid run up and anchoring, which was when traders focused on past low prices of the stock, and that caused traders to misjudge future value and the actual risk of the trade as the price rose dramatically, and there was limits to arbitrage, and there was the structural factors like trading halts and extreme short interest, which made it difficult for rational traders to execute trades to correct the mispricing quickly, and this prevented an immediate market correction, allowing the price bubble to inflate further and prolonging the short-term inefficiency. So the challenging market efficiency, um, for short-term and long-term was that for short-term, the price did not instantly reflect on only new fundamental information. Instead, they reflected hype, coordination, and emotional buying. The huge positive abnormal returns confirm this short-term violation. And to yeah, and then so that's for one of them. And then for the event study, market model estimation equation was this right here. And I estimated the parameters of alpha and beta by using daily log returns during the pre-event window, which was from June 1st, 2020 to December 31st, 2020. And the stat model output provided the specific values for these parameters. And for the alpha, this is the intercept of the regression, representing the expected daily return of GME when the S&P 500 return is zero. The beta is the slope of the regression. It represented GME's systematic risk or sensitivity to the market. A typical pre-squeeze beta for GME was likely close to or slightly above 1.0, indicated that it moved roughly with the market. And for the abnormal return, I used the estimated alpha and beta to calculate the expected return for each day in the event window from January 11th to 28th, 2021. I did all this sample. So to interpret the results, there was a huge positive abnormal returns. The sharp spike in CAR between January 13th and January 28th, 2021 confirms that GME's returns were vastly greater than what systematic risk model could explain. This is the quantitative evidence of the short-term market efficiency, semi-strong efficiency breakdown. Just the price surge was not justified by any equivalent release of positive fundamental public information. The semi-strong form of EMH was clearly violated, and prices reflected high coordination and short covering pressure and efficiency restoration. Rapid drop in CAR in early February suggests that rational force and fundamental valuations $10 to $40 began to restore efficiency after the immediate bubble burst. Okay, and basically, just talked about the behavioral, rational, and such. So it included the EMH forms. So if we're looking for the code that I did, it's the import finance, downloading the data, the GMB, the SPF, the SPX, excuse me. It's the daily log returns. You can find the estimating the alpha and the beta for here, and then the abnormal returns. It's the plot cumulative normal returns, CAR, and the study strongly suggests the conclusion that the GME short squeeze was a temporary but severe breakdown of market efficiency, and it was driven by behavioral biases and structural factors detailed in my evolve section. Technically, the whole thing was just behavioral thing, and it wasn't really rational. It was, like it says here, it was temporary, and it was very severe for the market, uh, for it to be efficient, and yeah.